Today, we're talking about Big Red. It's a company almost as familiar as McDonald's, with 85% of the US population living within 10 miles of one of its stores. Today, we're looking at pharmacy giant CVS and whether or not the average consumer can get any value from these stores. Hey everybody, and welcome back to Dollars and Cents, helping you make sense of making dollars. The first consumer value stores opened in 1963, selling primarily beauty products and some health-related items. The idea caught on, and CVS soon grew into a 17-store chain in just a year. Then, in 1967, CVS opened its first pharmacy in its stores. It didn't take long after for the company to sell itself to the Melville Corporation to fuel further growth. Throughout the 70s and 80s, this sale ultimately proved to be an incredibly smart move. CVS operated over 100 stores by 1970. 2 years later, CVS acquired 84 Clinton drug and discount stores. The company soon raked in $100 million in annual sales. A decade later, $1 billion in annual sales, acquisition after acquisition, ever expanding the company. By the 90s, CVS operated over 4,000 stores across the country. At the same time, another business began to rise, Caremark. It dealt in prescription delivery and management, and CVS wanted it. By 2007, CVS was looking to buy Caremark for $27 billion, and this merger made CVS the most powerful and streamlined pharmacy in the US, leading to sales topping $100 billion in 2012. Later, in 2018, CVS would merge with Aetna, a healthcare management giant. Today, CVS operates nearly 10,000 stores throughout the US, and boasts its position as the 7th largest company in the world by revenue. On that note, let's take a look at the healthcare titan's financials. We'll start with revenue growth. In 2016, CVS brought in $177.5 billion. By 2021, fueled by a few acquisitions, revenue had grown to $292.1 billion. Next up, shares outstanding. In 2016, CVS had 1.07 billion shares outstanding. As of the close of 2021, that amount had grown to 1.32 billion shares outstanding. It is important to note that CVS is buying shares back, and that large jump in shares was used to fund the Aetna acquisition. Looking at free cash flow growth, CVS posted $6 billion in 2016. Over the last 5 years, that had grown to $15.7 billion, but I imagine most of this growth had come from acquisitions. Now, let's compare the company's last 3 years of EBITDA to its net debt. The average stands at $15.5 billion of EBITDA over the last 3 years. Its net debt stands at $97.4 billion, meaning CVS has 6.2 times as much debt as EBITDA. Also important to note, more than half of its debt are capital lease obligations, the debt on buildings, standing at $85.8 billion. With that said, we'll get a rough company valuation by examining free cash flow. The 5-year average of the free cash flow is $10.5 billion. If we multiply this by 20, we get an expected market cap of $209.6 billion. Currently, CVS's market cap is $136.8 billion, which makes it seem like the company is fairly undervalued. On top of this, its free cash flow is skewed by Aetna's acquisition, meaning CVS is possibly even more undervalued than what we see here, but we'll get to that later. Moving on, we'll look at CVS's return on invested capital. First, the 5-year average ROIC is 6%, which is a little lower than what we would want to see. Meanwhile, last year's ROIC came in at a slightly better 8.9%, but still below our bar of 10%. Lastly, let's talk about the dividend. A 2.11% yield with a measly 23.8% payout ratio is the setup for a rapidly growing dividend, although its dividend growth rate is just 2.92% over the last 5 years. And this makes me curious why CVS hasn't grown its dividend faster, given that it could easily do so. Overall, I like CVS's balance sheet and growth. Resuming share buybacks, lots of cash on the balance sheet, and a dividend increase for the first time in 4 years seems really good to me. But like anything, we need to dig a little deeper to see the company's value, or lack thereof. Before we take that dive, I think it's important to look at a growing trend in both the United States and the rest of the world, the emergence of the telehealth industry. While bolstered by the 2020 pandemic, the industry has quickly become a new facet of how people interact with their doctors as a whole. First, this chart from McKinsey shows that claims via telehealth experienced a 38 times uptake from pre-pandemic levels, and have stabilized in this area. Also, this chart demonstrates a large uptick in venture funding for telehealth companies. Over the next few years, we'll really see the effects of this surge in funding with new companies cropping up. Finally, McKinsey estimates that approximately 20% of all Medicare, Medicaid, and office visit spending could be virtualized in the coming years. So, how does this all fit with CVS? Well, I think it all starts with Aetna. Last year, the company announced Aetna Virtual Primary Care. This starts CVS's plan to capture some of the rapidly growing telehealth markets. Aetna's new program partners with Teladoc and will allow members to see a virtual care physician. Of course, this physician wouldn't replace a primary care doctor, but would be a way for people to receive minor medical care and advice that would normally require an in-person doctor's visit. The addition of this program is only part of a greater plan to create what CVS calls a healthcare hub. CVS now has access to the 24 million people currently covered by Aetna, and this also makes CVS Health the third largest health insurer in the United States. This plan also includes shuttering 900 stores and a focus on transforming existing ones into what essentially amounts to an urgent care clinic. These clinics are places where people can receive medical care ranging from dealing with ear infections and vaccines to screenings for other chronic health conditions, all of this while maintaining the other regular drugstore offerings. Earlier, we touched on Caremark, the 2007 acquisition. In truth, Caremark is a pharmacy benefit manager and acts as an intermediary between patients and pharmacies to obtain the lowest price for people it covers. With this transformation of the remaining CVS stores, Caremark will undoubtedly prove to be a definite asset in this transition. Some incredible forward thinking on the part of CVS. Yet a transformation like this requires money, a lot of money, and CVS certainly has it. Being the 7th largest company by revenue in the world, CVS powers this plan with the massive amount of cash it generates. In fact, the company has so much money it resumed returning it to shareholders in heaps. In a recent announcement, CVS announced a huge share buyback program along with its first dividend increase in 4 years. The reason why CVS hasn't touched the dividend or bought any shares back over the last few years is because it's been paying off its debts, and it continues to do so today. In Q4 of 2021 alone, CVS reported it had paid back $2.3 billion of debt and $8.8 billion for the full year. Paying off these debts leaves CVS with its 3 business segments: Aetna, CVS Health, and Caremark. These transformations turned a relatively lowly, retail-focused drugstore chain into one of the most formidable conglomerates in healthcare, and all these roll up into one Goliath, but even a Goliath can fall. One of the most pressing concerns is competition. As I said earlier, telehealth and the healthcare industry as a whole are growing rapidly. This caught the attention of some really big players, most notably Amazon and Walmart. Amazon just recently opened Amazon Pharmacy, a platform designed to make getting prescriptions delivered more accessible. This platform integrates with Amazon's already expansive delivery network and presents a credible, real threat to parts of CVS's business. Then, on the other side of the coin is Walmart and its acquisition of MeMD a few years ago. Given Walmart's deep integration into the very heart of America, it makes sense for Walmart to beef up its already existing healthcare offering, although the healthcare segment does make up a relatively small amount of Walmart's total business. But should CVS see tremendous success with this new business model, and given Walmart and Amazon's financial firepower, I imagine these companies would attempt to seize a sizable portion of the digital market share away from CVS. And really, competition is the big issue with CVS in my opinion. As long as the company continues to innovate and transform to meet the growing demand for healthcare, I think CVS already has the tools to beat its competition, or at least have a fighting chance against those competitors. Still, in order to keep these tools sharp, CVS has to maintain its impressive growth from the last 2 years, and I believe that growth will slow down at least a little bit. As the immediate and pressing surge of the pandemic starts to fade, I don't expect to see the robust same-store sales growth of 13+% the company's enjoyed these last 2 years. That said, I think it'll still continue to grow at a respectable rate, just not as impressive or fast like it has. So that leaves us with the question, am I buying CVS? And incredibly, the answer is yes, just not right now. I think CVS's story is compelling, the transformation the retailer has undergone is impressive and successful. My only problem with it is valuation. I think CVS's share price should fall to the $85 to $90 range. That price point really isn't that far off though, and I expect to start adding it to my portfolio in the coming months. And that's all I've got for you in this video. What do you think of CVS's planned transformation? Is it a step in the right direction or not? Leave your thoughts on this healthcare giant in the comments section below, or hop onto my Discord where we can talk more. Until next time, I'll see all of you in the next episode of Dollars and Cents.